When it comes to crypto and its many currencies, the fact of the matter is that many people want to try and profit from it in as many ways as possible. While some simply buy and trade and wait for the right opportunities to turn up, others take a different approach to matters. For example, there is yield farming, which goes and handles things in a different way, but could get you some serious money if you play it the right way. Especially if you want to go after one of the more popular cryptos via Ethereum. Allow us to show you how to yield farm Ethereum. Number 10. What is yield farming in a nutshell? When you deposit money in a bank, you're effectively making a loan, for which you can get interest in return. Yield farming, also known as yield or liquidity harvesting, involves lending cryptocurrency. In return, you get interest and sometimes fees, but they're less significant than the practice of supplementing interest with handouts of units of a new cryptocurrency. The real payoff comes if that coin appreciates rapidly. It's as if banks were luring new depositors with the gift of a tulip during the Dutch tulip craze. Yes, that is apparently something that indeed happened. We try not to judge, so let's move on, shall we? Number 9. Strange crypto. It may sound strange, but you have to remember that unlike established currencies that have lots of money in circulation, cryptocurrencies have to perform a tricky balancing act to grow. A new currency only has value if enough people use it, so there's an incentive to issue new units to grow a user base. But flooding the market would make the currency less valuable. Remember, so far cryptocurrencies are sought after more for their value as a commodity whose price may rise with demand than for their usefulness in making real-world transactions, which is the main function of the dollar, euro, or yuan. Number 8. So how does it work? First, do you know what a dApp is? That's shorthand for decentralized app. Ethereum co-founder Vitalik Buterin explains that concept through this analogy. If Bitcoin is a pocket calculator, platforms with dApps are smartphones, but ones on which automated programs run without a central operating system or server. Many of them make use of the Ethereum blockchain or digital ledger. Number 7. Basic approach. The most basic approach is to lend digital coins such as DAI or Tether through a dApp such as Compound, which then lends the coins to borrowers who often use them for speculation. Interest rates vary with demand, but for every day's participation in the Compound service, you get new comp coins, as well as interest and other fees. If the comp token appreciates, it's more than doubled in value since mid-June. Your returns skyrocketed as well. Number 6. What is the SEC doing? In September, Coinbase Global Incorporated said the agency threatened to sue if the exchange lets customers earn interest in some digital tokens. At issue is Coinbase's Lend product, which had not yet been opened to investors but promised to let them earn 4% annually by lending out their USDC virtual tokens. USDC, which is offered by a consortium of firms including Coinbase, is a stablecoin, a fast-growing corner of the crypto market that allows traders to easily convert their digital assets into cash and vice versa. Coinbase's tussle with the SEC became public when Paul Grewal, the company's chief legal officer, said the SEC determined that Lend involved a security but wouldn't say who or how they'd reached that conclusion. Grewal added that the agency told Coinbase that if we launched Lend, they intend to sue, prompting the company to shelve the product until at least October. Number 5. What's the issue? Despite Coinbase's bewilderment, the SEC has long argued that a range of tokens fall under its jurisdiction. Over the past 4 years, the SEC has consistently asserted that many digital assets are invested contracts or securities based on legal theory known as the Howey test laid out in the 1940s Supreme Court case. The regulator's stance is that almost anything that gives investors the expectation of profiting from the work of others can be labeled an investment contract. The industry has countered that the SEC's view is too vague and unsuitable for virtual coins. The move is also likely to cause concern among the companies like BlockFi Inc., Gemini Trust Co., and Celsius Network that already offer services that let clients earn interest for lending out their tokens. New Jersey is among states that have ordered BlockFi to stop marketing some products. Number 4. What other kinds of coins are involved? Compound, which was launched in June, is one of the largest such services and currently has about $11 billion in funds, according to tracker DeFi Plus. Other major players in this game are Balancer, Synthetics, Curve, and Ren. Synthetics pioneered the idea. Today, these services hold more than $90 billion in locked user funds, which are funds that are used in lending. Supposedly, the holders of the coins like Comp can participate in the governance and improvement of these networks, but the vast majority of people using them currently are speculators trying to earn fairy tale-like returns. Number 3. What are the risks? Beyond regulatory crackdowns, there's theft for one. The digital money you lend out is effectively held by software, and hackers seem to always be able to find ways to exploit vulnerabilities in code and make away with funds. Some coins that people are depositing for yield farming are also only a few years old at most and could potentially lose their value, causing the entire system to crash. What's more, early investors often hold large shares of reward tokens, and their moves to sell could have a huge impact on token prices. Lastly, regulators are yet to opine on whether reward tokens are or could become securities, decisions that could have a big impact on the coins' use and value. Number 2. Other issues. Many high-yield harvesting strategies also carry the risk of liquidation. To maximize returns, many users are adapting complex strategies. For example, some investors have been depositing DAI tokens into Compound, then borrowing DAI using initial tokens as collateral, then lending out the borrowed funds. The idea is to get greater portion of the allocated rewards, COM tokens. A move in the wrong direction in a token's value could wipe out all gains and trigger liquidations. Number 1. Look at the market and caution. People have been able to earn interest by lending their cryptocurrencies for several years through apps like BlockFi as part of the trend of decentralized finance, or DeFi, in which middlemen like banks are replaced with the automated protocols of dApps. What's different about new ventures like Compound are the tokens handed out to lenders and borrowers, often with implied future rights to cash flows. The idea was to give people who use these apps some skin in the game by creating an incentive to participate in governing and improving the networks. When someone who has lent a cryptocurrency through a DeFi service like Compound then borrows it back, they're creating artificial demand for the coins and thereby inflating the coins' prices. That's raised concerns that early adopters who have accumulated large holdings, often called whales, are manipulating price movements, a common accusation in a range of crypto markets. Small traders should be aware that yield harvesting has become a game for whales who are capturing the vast majority of rewards, according to crypto research firm Messari. Amid the COVID-19 pandemic, all cryptocurrencies, generally viewed as an uncorrelated asset in the long term, have seen a surge of interest in light of high volatility in many traditional assets. What's more, many of the yield harvesting products only debuted this summer, offering highly attractive tokens as rewards and boasting of high-profile backers like Andreessen Horowitz and Polychain. Now, as in all things with crypto, you absolutely have to be careful about all of this, okay? As we've already shown, there have been some issues with yield farming already, and so with a new year on the horizon, you can't help but wonder where crypto is going to go from here. As a result, just like with other avenues of crypto, you have to be careful and understand just how the market works, or appears to work, and know what you're doing before you get involved. Sure, Ethereum may sound like a safe bet, but a lot of people would have said the same about Bitcoin, and it just had a massive crash that wiped out billions. So be wise before you do your farming. So what do you think? What do you think of this look at yield farming and how you might be able to use it in order to get more out of your Ethereum purchases? Do you think that this is something you could possibly do, or do you think it's best left to those who absolutely know what they're doing with crypto? Let us know below, and we'll see you next time on the channel.